Something broke, and it wasn't supposed to be visible. What you're about to hear is not a theory, it's not a prediction, and it's not based on sentiment, it's based on plumbing. Because something happened in the silver market that was never supposed to happen in public view, and it exposed a fault line running straight through the global financial system. This is the story of leverage, liquidity, and a paper market colliding with physical reality. And once you understand what just occurred, it becomes very hard to believe this system can return to normal. The modern silver market is no longer functioning as a price discovery mechanism. It is functioning as a leverage warehouse. For decades, banks and institutions have sold silver they do not have, using futures contracts layered on top of each other with extreme leverage. On paper, everything works, until price moves too fast, until margin calls arrive all at once, until liquidity vanishes, and until physical delivery is demanded in size. That moment is now. What we are witnessing is not just a silver rally. It is a systemic breaking point, where both the paper market and the physical market are under stress at the same time. That combination is rare, and when it happens, it does not resolve quietly. Let's start with leverage. In the silver futures market, large banks control billions of dollars worth of silver exposure with a fraction of that amount posted as margin. In many cases, a bank can control $100 million worth of silver with only a few million in collateral. This works as long as price moves slowly. Volatility stays contained. Counterparties remain confident. But leverage is asymmetric. Losses arrive faster than gains. And when silver prices spike, margin calls do not arrive politely. They arrive immediately. A $5 or $10 move in silver does not just hurt shorts. It can wipe out their available liquidity. And that's exactly what just happened. The smoking gun, December 26th. On December 26th, something extraordinary occurred. Major banks accessed the Federal Reserve's overnight repo facility for $17.251 billion. That number matters, because under normal conditions, this facility sees minimal usage. It is an emergency backstop, not a daily funding source. Yet on that single day, usage exploded. This was not random, it was not seasonal, and it was not coincidental. Because that same day, silver surged toward $79 per ounce. The timing is the clue. The conclusion is unavoidable. Banks needed immediate cash. Not tomorrow, not next week. That kind of urgency only comes from one place: margin calls. Why silver? Not stocks, not bonds. Some ask, why silver? Why would silver trigger a liquidity event? The answer is structure. Silver is uniquely dangerous to short sellers because it is thinly supplied, it is highly leveraged, it has real industrial demand. Physical delivery still matters. Unlike equities, you cannot print silver. Unlike bonds, you cannot roll delivery indefinitely when inventories are shrinking. Silver shorts are promises to deliver metal, and when those promises collide with price spikes, cash must appear instantly. That is why banks went to the Fed, not because silver is small, but because silver is tight. Physical delivery, the pressure point. Now let's talk about the physical side. December delivery demand on COMEX reached 63.5 million ounces. That number is staggering. It represents roughly 7.5% of annual global mine production, demanded in a single month. And this is not hypothetical demand. These are contracts standing for delivery, meaning metal must change hands. At the same time, registered COMEX inventories are falling. Registered inventory is the metal available for immediate delivery. When that declines during high delivery months, stress builds rapidly. This is how a short squeeze forms. Because shorts are not just buying contracts. They are forced to source real metal at any available price to fulfill obligations. And when physical supply is tight, price becomes secondary. Availability becomes everything. The feedback loop. How the system makes it worse. Here's where the situation becomes truly dangerous. The response to the problem is amplifying the problem. Let's walk through the loop. Silver prices rise. That triggers margin calls on leveraged short positions. Banks lack sufficient liquid cash. They go to the Federal Reserve. The Fed injects dollars into the system. Those dollars weaken the currency. A weaker dollar makes hard assets more attractive. More money flows into silver. Silver prices rise further, which triggers more margin calls, which requires more emergency funding. This is not stabilization. This is a doom loop. The intervention solves a short-term liquidity crisis, but worsens the long-term structural problem. Why this is different from 2008. Some will compare this to previous crises, but this is not a mortgage crisis. This is not a credit default crisis. This is a commodity delivery crisis. In 2008, assets collapsed because confidence disappeared. Here, prices rise because confidence in paper promises is eroding. That distinction matters. Because rising prices do not relieve pressure on shorts. They intensify it. And unlike stocks, silver has a physical constraint. You cannot rehypothecate metal that does not exist. Short seller capitulation. The quiet signal. There is another signal most people missed. The cost to borrow shares of silver ETFs like SLV has fallen sharply. At first glance, this looks bearish, but context matters. Borrow fees fall not only when demand weakens, they also fall when short sellers leave. Sophisticated players do not wait for disaster. They exit when risk becomes asymmetric. What this data suggests is not a lack of bullish pressure. It suggests capitulation by informed shorts. That removes a major source of selling pressure. And when shorts step away, resistance disappears. Why banks are trapped. Banks now face an impossible choice if they hold their short positions. Margin calls continue. Liquidity drains, emergency funding increases. If they close their short positions, losses become realized. Prices surge. Physical demand explodes. There is no painless exit. This is what it means to be trapped. And trapped players behave predictably. They delay, they roll, they hedge imperfectly, they seek intervention. But the clock does not stop. Systemic risk beyond silver. This is not isolated. Silver futures are embedded in bank balance sheets, derivatives, books, and counterparty agreements, collateral structures. Losses here ripple outward. That is why the Federal Reserve intervened, not to save silver traders, but to prevent contagion. Yet every intervention introduces moral hazard. Risk-taking is rewarded, leverage is validated, and future crises grow larger. Currency consequences. Every dollar injected to stabilize the system has a cost. That cost is currency dilution. As more liquidity enters the system, confidence shifts, not overnight, but steadily. Hard assets benefit, not because they are exciting, but because they are scarce. Silver does not require belief, it requires extraction. And extraction is slow. Why this is a regime. Change. This is not about price targets. This is about structure. We are moving from a financialized regime where paper dominates price to a constrained regime where physical reality asserts itself. These transitions are messy. They involve volatility. They involve policy intervention. They involve denial, but they always resolve the same way. Through repricing. Expected path forward. Volatility is the message. What comes next is unlikely to be calm, not because markets are irrational, but because systems under strain do not resolve cleanly. When leverage is excessive, inventories are thin, and confidence begins to fracture. Volatility becomes the communication mechanism. It is how stress expresses itself before failure becomes visible. Expect larger and more frequent Federal Reserve interventions. Liquidity facilities will expand quietly, then openly. Emergency measures will be reframed as technical operations. Balance sheets will grow again, not because policymakers want inflation, but because they cannot allow cascading defaults. Expect increasing volatility. Wide daily ranges will become normal. Price discovery will feel unstable, not because demand disappears, but because the market is searching for a level where sellers are forced to reveal supply and finding very little. Expect spikes, followed by sharp pullbacks. These are not reversals. They are pressure releases. Each rally exposes weakness in short positioning and settlement confidence. Each pullback is an attempt to regain control, to restore order, to signal normalcy. But control becomes harder to maintain with each cycle. Expect continued inventory stress. Registered inventories will be watched closely, quietly, obsessively. Drawdowns will accelerate during delivery months. Reclassifications will increase. Language will soften. But the direction will remain the same. And most importantly, expect rising distrust in paper settlement. This is subtle at first, then it becomes structural. Delivery premiums widen. Cash settlements increase. Delays are normalized. Exceptions become policy. This is not a one-week event. It is not a headline. It is the early phase of a longer unwind, one driven not by speculation, but by arithmetic. Implications for participants. What this environment rewards and punishes. This environment does not reward speed. It rewards positioning. It favors those who understand that late cycle markets behave differently from early cycle ones. It favors unleveraged positions. Because leverage amplifies timing risk. In structurally stressed markets, even correct positions can be liquidated at the worst moment due to margin mechanics rather than fundamentals. Physical ownership. Because possession removes counterparty exposure. It eliminates settlement risk. It converts a financial claim into a tangible asset that exists outside clearing systems. Long-term thinking. Because structural transitions do not resolve in days or weeks. They unfold unevenly, often violently, but directionally over time. At the same time, this environment punishes certain behaviors. Harshly. It punishes excess leverage. Because leverage assumes liquidity. And liquidity is precisely what disappears first in stressed systems. It punishes short-term speculation because volatility destroys precision. Stops get run, models fail, correlations break, and it punishes blind faith in paper claims. Because when trust erodes, paper promises are questioned, and questioned promises must be honored, renegotiated, or abandoned. This is not a trading market. It is a structural transition. And structural transitions do not care about entry points. They care about exposure, risk disclosure. Let's be clear. There are no guarantees. There are no perfect strategies. Markets can remain volatile longer than participants expect and longer than logic suggests. Intervention can delay outcomes. It can distort price signals. It can create false stability, but it does not eliminate underlying constraints. This analysis is not financial advice. It is an examination of system behavior under stress, how leveraged markets respond when liquidity thins, inventories decline, and confidence begins to fracture. History shows that these phases are unpredictable in timing, but remarkably consistent in structure. When paper meets physics, what we are witnessing is not simply a silver story. It is a credibility story, a story about leverage meeting limits, about promises colliding with inventory, about liquidity masking scarcity until it no longer can. For decades, paper markets have been able to set prices. They could do so because physical demand was manageable, inventories were sufficient, and confidence was intact. But paper can only lead until physical delivery is demanded. And when that moment arrives, when claims must become metal, reality takes control. This is not fear, it is awareness. Because once systems reach this stage, they do not unwind politely. They adjust, they fracture, they reprice. If this analysis helped you understand what's happening beneath the surface, like the video, share it, subscribe, because this situation is evolving in real time, and when leverage finally breaks, it won't ask for permission.